Are you feeling completely lost in the sea of investment advice out there? Well, today, we're going to cut right through all that noise. I'm going to show you how to build a powerful, simple, long-term portfolio. Let's dive in. You know, if you've spent even 5 minutes online looking for investment advice, you know the feeling. It is just a constant flood of tips and tricks and these can't-miss opportunities. It's loud, it's confusing, and honestly, it can feel completely paralyzing. So on one hand, you hear this really simple, elegant advice, just buy the whole market and let it do its thing. But then, on the other hand, you see these super complex strategies with this dizzying alphabet soup of tickers. Both sides are so passionate, but they can't both be the best place to start. This is exactly the noise we're going to slice through today.
So how do we find some clarity in all this chaos? Well, the answer lies in one surprisingly simple tool for building a really strong portfolio: the exchange-traded fund, or as you know it, the ETF.
Think of an ETF like a basket, and in that basket are hundreds, sometimes even thousands, of different stocks. So with one single purchase, you're not just buying one company, you're buying a tiny slice of an entire market or an entire sector. It's a total game changer for building a solid foundation.
So why are ETFs so powerful for building your core portfolio? Well, first, you get instant diversification, which is just a fancy way of saying you're spreading out your risk. Second, and this is huge, they have incredibly low costs. This is so crucial because it means more of your money is actually working for you, not getting eaten up by fees. And finally, they trade just like a regular stock, which makes them super easy to buy and sell. All right, let's get practical. We're going to look at 3 specific ETFs that can act as the bedrock for a simple, globally diversified portfolio. Okay, let's look at 3 heavyweights here. First up is VOO, which tracks the 500 largest companies in the US. Then you've got VTI, which goes even bigger. It covers the entire US stock market. And to make sure you're not just betting on one country, IXUS gives you thousands of stocks from all around the world, excluding the US. Now, pay close attention to those expense ratios. See how tiny they are? That's the percentage you pay each year, and that low cost is exactly what you want to see. Now, a question I see all the time is, should I choose VOO or VTI? And this slide breaks it down perfectly. Think of VOO as the blue chip titans, the 500 biggest players on the field. VTI includes those same giants, but it also adds thousands of mid-sized and small companies. Basically, it gives you a snapshot of the entire US economy. So it's a choice between betting on the all-star leaders or betting on the whole team. So building the portfolio, that's step 1. Step 2 is understanding the engine that's going to drive its growth over decades. And that, my friends, is the magic of compounding. Let's just imagine for a second we build a simple portfolio using these building blocks we just talked about. We'll put 70% into the total US market with VTI and the other 30% into the rest of the world with IXUS. That's it. A simple, globally diversified, and really powerful starting point. Now let's see what happens over the long term. If you just tucked away $100 a month in a savings account for 30 years, you'd have about $38,000. Not bad, but if you invested that same $100 a month and earned a pretty average 7% return, you'd end up with over $122,000. That's the power we're talking about. I mean, that's an $84,000 difference. And that's not just from the money you put in. No, that's your money making more money, which then turns around and makes even more money. That is the incredible, undeniable power of compounding right there. That incredible growth is the goal, right? But playing the long game also means you have to protect what you've built, especially when you start getting closer to retirement. And to do that, you have to understand one really crucial risk. This risk has a kind of scary name: sequence of returns risk. But in simple terms, it's really just the bad luck of having a big market downturn right when you need to start taking money out of your portfolio. The order or the sequence of your investment returns matters a lot. This quote here from Commons Capital just explains it perfectly. If the market tanks and you need to sell some investments to pay your bills, you have to sell more shares to get the same amount of cash. And once those shares are sold, they're gone forever. They can't recover when the market bounces back, and that can permanently damage your portfolio. And this table shows just how devastating this can be. Look at these 2 retirees. They both start with $1 million, and they both get the exact same average returns over time. The only difference is the order of those returns. Retiree A gets lucky with good years first. Retiree B, not so much. After just 10 years, Retiree B's portfolio is less than half the size of Retiree A's. That's sequence of returns risk in action.
So how do you protect yourself against this? How do you reduce the role that pure luck plays? Well, one of the most powerful tools you have is to diversify, not just across different companies, but across the entire globe.
And here's the proof. Research from Vanguard shows just how powerful this is. They looked at the historical success rate of a pretty common withdrawal strategy. A US-only portfolio succeeded just 36% of the time. But when you added international stocks, that success rate jumped to over 56%. That is a massive, massive improvement.
It's exactly why Nobel Prize-winning economist Harry Markowitz famously said that diversification is the only free lunch in investing. By spreading your bets globally, you can actually increase your chances of success without taking on a ton of extra risk. So, as you look out towards your own long-term horizon, just remember the main takeaway here. Building a strong core portfolio does not have to be complicated. By focusing on low-cost, globally diversified ETFs, you can cut through all that noise and set yourself up for the journey ahead.
This approach gives you an incredibly solid foundation. It's simple, it's effective, and it's built for the long haul. So the only question left is, once you've got that foundation set, what are you going to build on top of it?